maybe Mike, we can pivot over to you to begin with here. We're in sort of a weird market right now where rates are high, inventory is low. When we were preparing for this call, you mentioned that there are, though, historic precedents for what's going on right now. Talk to me a little bit about that. How do we make sense of this current moment?
Happy to. And again, good morning, and thank you for being here. And I'm really happy to see everyone. I'm excited to hear the thoughts of Billy and Avi, and just really appreciate everyone here. So when we look at this market, and it is crucial to identify that there is something very different about the market we're in right now. If we go all the way back to early 2000, the number of units that will sell in the United States this year is significantly off from what we've experienced for a number of years. Going back to 2012, we've always had more than 5 million units sell each year. This year, we will barely cross 4 million. It was 6 million in 21, but it was 5 million all those other years, right? And we're barely going to cross 4 million. And this has led to this, unique circumstance where prices are still going up. We have lots of, people forecasting 6% growth, 7% growth, but we're off about 20 to 25% on volume. So why is that? Why is it that we have so many people who want to buy, but the normal intersection of supply and demand is pulling back the supply from hitting the market for how many buyers actually want to be buying right now? And what we see is that we have 1/3 of homeowners sitting on an interest rate under 3%. We have another third sitting on an interest rate under 4%, right? So basically 2/3 of homeowners are sitting on a rate under 4, conversed with the reality that 2/3 of home buyers are normally home sellers. And this is what's so fascinating about what we're dealing with right now. So we can go back 40 years. And it was just a graph that came out about this if you want to Google it, right? We go back 40 years. There's only one other time where you can see the spread between the interest rate that homeowners are sitting on versus the interest rates that are in the marketplace overall. And we haven't seen this since basically 1981, 1982. And what happened was when we had, there was a real estate boom, for those who don't know, or those who do know, it's memory. There was a real estate boom in the late 1970s. And a lot of people were excited at the time that they were buying in 6, 7, 8% rates. But then what did we have? We had an inflationary pressures, interest rates rose, and we had this reality in the early 1980s where all of a sudden rates were 15, 16%. I know Billy has shared before, maybe he'll share again, he bought a house at 15%. He was like, hey, it's 15%. That is what it is, right? And that's true. You will notice that buyers just entering the market, the rate is what the rate is. They're not, bummed out about, they're sad that they didn't catch the 4 or the 5, but they still want to buy. But it's much different from a homeowner's perspective. A homeowner who's debating whether or not to, buy a move-up house or, move down into a condo, when they're sitting on their 3%, and they don't want to let go of it for a 7%, right? So you have this situation, especially, there are other factors involved in this, remote work, rental prices, et cetera. But basically, the inventory is not hitting the market for the demand that is out there. And we have seen this reality before. We saw it in 1981, 1982, which was the last time we saw as much of a spread between the current rates versus the rates that homeowners were sitting on. And it took a couple of years for that to just play itself out, for enough people to buy at the higher rates, that enough turnover starts happening. And just for some food for thought, some stats to chew on, we have 82,500,000 homes roughly in the United States of America that could transfer, house, condo, what have you, privately held homes according to US Census data. If you look right now, there are only 660,000 homes on the market in the entire country. All right, 82,500,000. That's your available inventory that could hit the market, and only 660,000 homeowners have decided, yeah, I want to sell right now. If you go back to 2007, you could find 4 million listings on the market, right? But now we have just a few 100,000 listings on the market, and that's a unique reality for real estate agents because the number of agents are staying pretty constant, right? So whereas you go back to 2007, you have 3 listings for every 1 agent. Now we have a situation where it's basically 3 agents for every 1 listing. And that's the difference. The prices, they're stable. They're actually going up. right? People wanting to buy, they're out there. But we have this insane reality on inventory, which also you can tie back to mortgage forbearance, foreclosure moratoriums. There was a lot of supply that could have hit the market a couple of years ago that did not hit the market. And we really, just altered the landscape of normal supply and demand patterns. And that's what we're sitting on right now.
Let me jump in there, Mike, and ask a follow-up. You talk about sort of the ratio of agents to listings today and kind of going back in this century, but you were also talking about sort of the early 80s. Do you know what was that ratio back when we saw like sort of the equivalent scenario 30, 40 years ago?
Yeah, I seriously wish I knew the answer to that. If I spit out a number though that I don't know, then I'm going to look like a schmuck later.
That's
I
okay.
can tell you, that the number of agents has stayed relatively constant going back at least the last dozen years. No, if you look at NAR data on the number of realtors, you will see that agents have been roughly between 1 million to 1.4 million, like that range for a dozen plus years. I'm gonna look real quickly while other people talk because it's gonna eat at me. But my instinct is we probably would find a similar situation because I know I've read about articles about how many people jumped into real estate in the 70s and 80s, right? I think there was a similar reality off that boom. You probably would find a similar situation based on the inventory in the early 1980s as you would, now on a ratio. And I just looked into this because there were so many articles. I mean, Plenty of Inman put forward, like, oh, it's the lowest inventory since 1982. It's the lowest inventory. And it just got me, interested. What was going on in 81, 82, besides good John Hughes movies? I mean, like what was happening that, the inventory was so crunched at that time. And it literally is the same situation. You just had same thing. 2/3 of homeowners sitting on a rate, half of what the current rates are, and therefore that's the reality you see. It's a 1+1 situation.
Yeah. Okay. Fair enough. I want to get to our other panelists here, but really quickly before we do that, you mentioned sort of like it took a couple of years for the situation to work itself out in the early 80s. And I think a lot of people are wondering, like, sort of what is going to happen here? How long is this going to take? And are we going to see rates rise? Are we going to see them go down? Talk to me about kind of the next 6 months to a year. Like, are we basically going to be in this same place? If we have the same conversation a year from now? How long is this going to take?
All right, I'm going to take a sip of my magic tea here and figure it out. Okay, look, obviously, if anything that the last few years have taught us, like we can't fully predict, because then, life smacks us in the face. But
Right.
let's say all things being equal, right? We actually have evidence, even within the current marketplace, of a different universe that comes about. Anytime you wake up, you just check the 10-year yield, right? The 10-year yield is 4.25 right now. The 30-year fix tracks the 10-year yield. I know we all focus on what the Fed does or doesn't do, but it's the 30-year fixed mortgage tracks the 10-year yield, right? So when we see that yield drop, which ironically it dropped during the SVP, banking issue, it dropped it, towards the end of last year. When the yield falls to the low threes, then the rates are suddenly in the high fives, right? So twice in the past 14 months, we had a couple of periods where the rates fell into below 6, right? Each one of those times, if you track what happened on pendings and sales, we had a spike up, immediate, right? Rates hit the mid to high fives, we get more activity instantly, right? So there's a lot of predictions right now that we should see, we had a good inflation report today. The more good inflation reports, the better, right? But we have two possibilities for it to play itself out. Possibility A, rates fall into the high fives. Rates fall into the high fives. We're in same market as 2018, 2019, that level, just pure activity. Things are great. Employment's 3.6. If you remember, people tend to forget, but there was a spike up before COVID happened on real estate. If you go back to what was happening in real estate, even before the pandemic, things were accelerating, right? You would have a market like that with rates in the high fives, okay? But conversely, there's another reality where rates just stay in high sixes, low sevens, maybe even mid sevens, right? In that situation, you simply need enough half to sellers, right? Death, divorce, job loss, etc., combined with the want to sellers, and enough people who bought at rates above 5% who are then doing normal turnover, right? In that case, it takes about, based on what we saw the last time this happened, 18 months to get back into a normal cyclical market on those units. Again, we're talking about two different realities. There's the price reality where we're stable to up, but then there's the units reality where for the most part, we are just down 20, 25, even 30% in some places on just how many homes are transferring over, right? Lawrence Yun made a joke. You will see, the divorce rate go down because enough couples are like, yeah, I might not be able to stand you, but I love that 3% rate and we're not letting go of this house, right? It's kind of that phenomenon.
Okay. And then really quick, just again, before we kind of move on here, we're talking about sort of the units being down this year. And I guess I'm wondering, if that downness is going to be equally distributed across the whole year. In other words, the fall is typically a slower time for real estate than, say, the spring or the summer. Are we going to see a sort of proportionately slower fall? Or have we sort of gotten all of this out of the way? Are people kind of coming back? I guess I'm wondering kind of like, is this fall going to be slower? Is it going to be normal? Is it going to be harder?
I don't think anything's normal anymore. I think we have to get out of the
right.
like of normal. I think if we see the rates slide down half a point, then people will be very happy to buy at Hanukkah, right? They will be very happy to buy. I mean, it's all connected to the rates. It is. I don't think it's as seasonal as it was because that is a big deal. If you had 6.1 million homes sell in 2021 and we're barely going to pass 4 million this year, that is a significant difference. Now, that's still 4 million people transferring real estate, right? But you're talking about a dramatic shift in how many homes are transferring. But a lot of those people do want to transfer. There's a lot of people who want to buy. You have a lot of pent up demand sitting within current unsold inventory. The moment those rates drop just enough, it's immediate. And we saw it actually last year. If you check the data from, like October, November last year, we had a sliver where there was a drop in the rates and then there was a spike up in activity, right? So I say, get out of the idea that it's seasonal, get more into the idea of making it a habit to wake up in the morning, see what the 10-year yield is. If you see the 10-year yield fall to 3.9, you're going to see more activity. I don't care, if it's Thanksgiving or not.
Okay. Well, Mike, I'm sure that we'll want to come back to you a bunch, but I'll stop giving you a grilling here and give other people a chance to talk. Billy, let's pivot over to you here. You're obviously seeing a lot of people, how they're responding to this, a lot of industry members. Talk to me about sort of what types of responses you're observing from members of the industry. How are people working in the conditions that Mike was describing?
Yeah. Well, firstly, great to be here, and thanks for hosting this, Jim. And always great to hear what Mike has to say, and looking forward to what Avi has to contribute as well. I mean, look, this is a difficult time if you compare it to what I call it sort of the post-COVID spike of this market. A lot of people have short memories. A lot of agents have short memories in particular, and they think, oh my God, the real estate market is falling apart, and what am I going to do? How am I going to make money? This is terrible. We're in the worst market ever. But I've been doing a lot of sort of looking back in history, and if you look at today's metrics going across number of listings, number of sales, dollar value of sales, dollar pendings, days on market, a lot of the metrics today look very similar to they did in 2018, 2019. And we've forgotten that already because we got used to basically being an order taker and churning deals and making them move, and it was a fun, exciting, lucrative time. But it's a time where we really have to go back to being an agent, which we were doing in those days. And as Mike was saying, there's a couple things. One is that I think though we have had seasonal periods in the market, we're in a new normal, and I think all bets are off for a while. And I think that as Mike said, my first house I had a 15 or 16% interest rate, and that was just what was normal at the time. And once we get to a feeling again that 5, 6, and hopefully not 7, but maybe 7% rates are what are normal, and I think what markets like are stability and consistency. And I think we're actually starting to get that now. If you look at the statistics, things are stabilizing. People aren't maybe happy about the fact that rates are at 5 and 6, but as long as we can get some stability, people can understand, now is, what the new normal is. And as buyers are very rate sensitive, once they see that they can get something they want for a price they can afford, and at a mortgage they can afford, then they're going to be jumping in. And as Mike said, you can see those troughs and valleys, peaks and valleys, where rates have gone up, gone down, and people have jumped in. I think that my personal home is on the market at the moment. Everybody wants a great home. You can come, perhaps take a look at mine. But I think that what it's done is it's given me a real up close insight to what is happening in the market. During I think the 2018, 2019, and even times past on Caravan, when real estate agents scurry around town to see what properties are available. You would like a good, decent, solid turnout would be like 40 agents. We got into the, post-COVID spike, you'd see maybe 50, maybe more. As soon as we got into this, new market, and I think as we got used to agents and generally people working from home and not really getting out of what they slept in and wandering around in their socks and walking around the house on the phone and grabbing a snack and getting distracted with whatever else is going on, agents aren't as motivated. They're not going out there and doing the job as much as we used to. And so, I feel like today, a good Caravan is like 15, 25 people. So I had my house on Caravan day after Labor Day last week. And I was expecting, because day after Labor Day, I'm going to get 10 to 15 people out. And I had 50. So it was a really, really big turnout for that Caravan. I had two women who were dying because they had really wanted to get their husband there. They were effusive. They were, really exuberant about the house. Really, really liked it. And they said, I'm going to get my husband here, right away. We're going to be there on Sunday for open house. And in the post-COVID spike market, they'd be there that night or the next day. But we've gotten to this lack of urgency in the market, this sort of lack of motivation, of malaise, if you will, because of the fact that it's not exactly what I want to pay. It's not exactly what I thought I was going to be having to, lay out every month.
Did they come, by the way, on Sunday? Did they come to the open house?
They
Those
did.
two people?
Yeah. One person's told me they're writing an offer, so we'll see.
Okay.
But it's a different move. The moving the speed of the market today is much more plodding. It's much more deliberate. It's much, it's not so convenient. And I think that's one of the things that, as we look at seasonality, particularly as we look at like LA and Southern California, homes here, there's a seasonality because it's warm, it's sunny, it's light, it's bright. You have some time off, you can go see homes. Maybe it's even kind of discretionary because it's fun. As we get into the holidays, in particular, when it gets cold, wet, you've got distractions of the holidays and people visiting and shopping and events, and it doesn't happen as much. And I think we will see declines to some seasonality effect. But I do think that as people get more accustomed to the rates, and and hopefully we'll get through this like perfect storm that we're seeing, with the WGA, the Writers Guild of America, the Screen Actors Guild, or SAG strikes. There's been a decline in wealth in the stock market and the crypto markets. Here in LA, we've got Measure ULA, which is impairing seller proceeds by 4 or 5.5%. You've got this war, you've got bank failures. There's a lot of kind of noise and direct impact that, again, as we can get through some of this, get more consistency and stability, we're going to see sales pick up. And I think people are just going to come, as Mike said, and as we all know, there are those that have to buy and sell. Death, divorce, death, downsizing, relocation. Sales will occur. I tell my clients, if you're a buyer, look, we know rates are going to come down. It's a question of when, but you can always refi. And if you are working with a lender, and I'm sure Avi, hopefully, I'm setting up a softball for you, Avi, but that, there are lenders who, if you, buy with them, they'll allow you to refi, free or favorably, if it's within a certain period of time, so that you can go off of maybe your interest only, rate that you may lock in and get this house. And then when rates, settle down a little bit, you can refi, and, Avi will tell you, yeah, we'll do that at a better rate.
Well, Billy, let me jump in there because I have a couple of follow-ups that I'm afraid I'm going to forget if I don't run them by you.
Go.
You mentioned like all these sort of like factors like the war and the strikes and that kind of thing. And I know we in our chat here we have someone mentioning like unnatural factors stagnating, like capital gains, tax portability. And I know, for example, also like in Southern California and LA specifically, you have like the so-called mansion tax, right, which is a policy that's being considered in other jurisdictions across the country as well. I guess maybe let me focus specifically on that one. Like, have you seen much impact? Like, are we seeing fewer sales in that price range? If people are working in other jurisdictions that might impose that kind of thing, should they brace for an impact? Like, is that a big factor that you're seeing?
Yeah, in fact, if you look at the data, you'll see a spike. It took effect April 1st of this year. And if you look at March sales, there's like an unprecedented spike up on the number of sales, and it has dipped down in that 5+, 10+ band with and look, I think a lot of us are optimistic, if not expecting that the measure is going to be considered unconstitutional. And there are two lawsuits at the moment that are claiming that it is unconstitutional and therefore needs to be invalidated, be retroactive. The taxes which have been collected by the LA County Assessor, which are being held, frankly, because they know there's a good chance that will be held in unconstitutional, will be returned. There's also a ballot measure that's on the November 24 election where voters can vote that taxes which were like Measure ULA, which have been enacted and didn't pass with a 2/3 vote, are invalidated retroactively as well. And there is a fairly strong belief that they will be invalidated, that this tax and others will be invalidated. And I think we're going to see really the first round. The hearing is going to take place. I think it's in October or November now. There's been a couple of judges that have recused themselves or been removed. So I'm sure that's going to be appealed. Probably over the California Supreme Court. We may not even know the resolution of that until we've already got the measure, the new ballot measure figured out, and so maybe moved. But it definitely has had impact.
Do you think, I mean, if you were advising agents, I know we've got people from all over the country, all over the world, actually, in this group here. Should folks be bracing for this? Like if you're in Chicago, if you're in Boston, if you're, places that have a lot of high-end properties, would you advise them to do anything as other municipalities consider these policies?
Well, look, I think that taking LA as an example of what occurred here, the proponents of this tax, they framed it so fantastically. It was called a mansion tax, and it was, basically, taxing the wealthy to address the homelessness, the unhoused concerns that we have in LA, which are real. And what I think consumers, average Joe didn't realize is that the mansion tax applies to every piece of real property. It could be an apartment building, it could be a piece of land, it could be a parking lot, a commercial building. It's everything, and it applies to the sales price, irrespective of whether you've made money or not. So what's going to happen is less sales will and have taken place. Also, the costs are going to be passed off to the consumer. So, apartment buildings are going to become more expensive, which means that they've now got to raise the rents. So it's not, and we've never really had a good solution here. I mean, there's been, as I understand it, $1 billion in the general fund that have been sitting there waiting to be addressed to homelessness, and nobody's really been able to gain a consensus on how to do that. So, this is a very thorny, difficult political situation and just pragmatic situation. How do you make it happen? But Culver City has a tax, Santa Monica has a tax. They do exist, but I think we here in LA didn't. It kind of just snuck in under the radar. Nobody really understood it. It seemed great on its face by the way it was framed, and I think there just needs to be a better observation and vigilance as to when these things are coming and how they're going to really apply.
Yeah. Okay. And I see again in our chat, we've got some folks sharing examples of other places that are doing similar things. So obviously this is not something that is unique just to LA, as you mentioned, other municipalities down there in Southern California.
And one of the things that, by the way, was mentioned is that there are other territories have enacted, and then they've gotten to normality on that, and it goes back to consistency and stability again. Once we realize this is the new normal, it's business as usual.
Okay. Well, I want to pivot back to some of the other stuff you're talking about here, but before we do that, maybe we can jump over to you, Avi. When we were talking, when we were getting ready for this call, we were talking about some of these external factors, and you had some interesting things to say, I thought, about sort of like climate change and natural disasters. Talk to me about sort of how that topic intersects right now with the housing market, because that's sort of another kind of weird thing that's going on right now. What do you see in that sort of field, Avi?
Yeah, so I think until recently we've all taken sort of insurance to be a given, right? It's sort of a side thought. We'll get the insurance. There have been plenty of choices to get it. It's been fairly easy to purchase. It's been fairly cheap to purchase. It's not factored into people's decisions as much at all. But all that has changed just in the last few years. And I think what's happening now is that the matter of fact is the premiums for home insurance have simply not kept up with the changes over the last few decades, let's say, right? I mean, I bought my first primary residence 20 something years ago, and I'm not paying that much more today in insurance than I was paying back then. And if you look at gas prices and other, consumer goods prices, they've all almost doubled in this time frame, or maybe even tripled. So premiums have not kept up with what's going on with inflation, especially in the last 3 or 4 or 5 years. And then couple that with the fact that climate change is now causing a lot more frequent and costly catastrophic events that's hurting everybody. And the cost to replace and rebuild homes has, because of inflation again, has gone up significantly. So that perfect trifecta of factors, inflation, the cost of replacing and rebuilding, as well as climate change effects, and what it's doing to areas that weren't thought to be risky initially, right, have now come under the radar of scrutiny of carriers. So I think what's happening, especially in markets like California, is that carriers are now having to go back to the drawing board and figure out how they can actually stay profitable and stay, liquid to be able to provide insurance, for the long run, and having to redo their models and refile for price increases with the state departments. And that, of course, is a long and laborious process. So in the meantime, they've all have sort of been compelled to take a step back and say, hey, either I'm going to restrict writing new policies in areas that I'm not certain about, or I'm going to, in some extreme cases, pull out of the states altogether, or not renew existing policies if they have the slightest hint that that homeowner is going to be a riskier risk than somebody else. Right, so there's taking all kinds of sort of mitigating measures to be able to stay in the green, if you will, during this time period. But I think it's temporary. I mean, this is something, it's sort of come to Jesus for these guys. They're trying to figure out what corrective measures they can take and how quickly they can take those. Some of it is at the mercy of the state departments of insurance. In some other states like Texas, not so much. They have different things happening there. But at least, speaking of California, those are the sort of the factors at play. And now, what companies like us can do with technology, et cetera, is trying to be as transparent to the consumers as possible, highlighting what are the risks in their location, in that neighborhood, in that, in their market, so that they can actually take corrective actions. Some carriers will give you a discount for taking corrective actions. If you go to clear the brush around the house, you may qualify for a discount. Some others may actually not even insure you if you don't do that. There's lots of different factors at play here, but what we can do from a technology perspective is being transparent to the home buyer, the homeowner, helping them understand what to look out for, what corrective measures can they take for their own good, but also for the good of being able to get insured at a reasonable price, and to make sure that they can actually maintain their insurance, because 3 strikes and you're out. And maybe these days it's 2 strikes and you're out, or 1 strike and you're out, right? From an insurance carrier's perspective. And so you got to be careful about mitigating those claims, or at least the likelihood of having a claim in the first place, which can not just shoot up your premiums, but in these markets, it may even just disqualify you from that policy. You may have to go hunting for something else. So I think that's what. Go ahead, Jim.
Oh, sorry. I want to jump in there because it may disqualify you, and it actually makes me wonder how big of an impact do we see this issue having on like the supply and demand, right? Like we were talking earlier about how prices went up and then interest rates went up, and some people are just not willing to deal with that, and so fewer homes end up on the market. The supply is down. Are we at a point where like insurance becomes too expensive and it's knocking buyers and sellers out of the game? It's knocking communities sort of out of the game, making them unaffordable for folks. Talk to me about how some of these things are impacting the supply of homes and kind of the sort of how quickly they transact.
I don't think we're there yet. I think, first of all, the inventory shortages exist, so people are certainly looking to buy, and there's much to go around anyway. It does factor into affordability, as more than it did before, because now the premiums, instead of being $2,000 a year, could be $4,000 or $5,000 a year, and you may have to add on additional coverages that your regular policy may not include anymore. So that sort of adds another layer of expense to your, to your affordability index. So I think, we're not there yet, because again, everything else, it's all relative. Insurance, even though premiums will go up, it's still in the context of your mortgages and everything else, it's still, a smaller piece of it. But I think, it may become that way, 5, 6, 10 years downstream. But, at least today, I don't see that people are fleeing areas where insurance is either harder to get or more expensive to get. I think people will live in areas that are desirable, and they will become more educated to go take care of things so that they can mitigate these kinds of issues. Again, the job of companies like us is to help educate and give those kind of insights to these people so that they can take corrective actions.
Yeah,
if I can jump in
a comment here in the chat: $13,000 for insurance on a $2 million home. It's a lot of money. I mean, obviously, maybe that's not going to deter you from the home, but still.
Yeah, it can become, for certain homes which are in maybe high risk areas, like there's a lot of brush fire around you, or it's in a high flood zone. These things can add up quite a bit. Yeah.
Yeah.
And if I can add to that, while and I see that people are adding in the chat on this, as far as the magnitude of the additional costs that coverage is causing. I have a number of wealthy homeowners who live in areas where you can only get California Fair Plan, and the coverage is not enough for their home. So they're definitely considering selling it. I definitely have buyers who say, I don't want to be north of Sunset because I don't want to have to worry about that. I want to make sure I have enough coverage to cover my largest asset that I own. So while I don't think that we're seeing an exodus or a huge change in those properties, I think we will see them over time. But I think we're going to get carriers who are going to come back when their rates make sense, and that'll be all brought into the fabric of the cost of the home.
You say north of Sunset. I guess I'm curious, like, are we talking about homes like in like Bel Air and places that we're not talking about like a cabin in the mountains, right? Like we're talking still in the urban general area. Right?
And Avi can probably address this better than I can, but my understanding is you're above Sunset or above or south of Ventura, so the Hollywood Hills, that whole range of mountains. That's all fire zone, and generally speaking, carriers are not in that marketplace.
Yeah, and another area, risky area from a carrier's perspective, has become coastal areas, of course. And 25 miles from the coast, that big range of properties, those have become really hard to insure. Or at least the premiums are going up considerably.
Because we got tsunamis.
We're talking about wild. Oh, sorry, Billy, go ahead.
I was joking because we got tsunamis coming.
Well, I mean, yeah, like we have, we're talking about wildfires, but yeah, like someone mentions here, sea level rise, like, there's a place like Miami, right? Like, Avi, are
Yeah.
you seeing impacts in places with other types of natural disasters? Is this a big deal?
It is across many, many states in the country. I mean, Texas, of course, we've seen a lot of climate change related catastrophes there. Florida is even worse than California is in many ways because of hurricane risks that are becoming even more frequent, and the damages caused are even more expensive to fix. So yeah, I mean, this is not localized. This is certainly, it's not everywhere yet, but at least it's in many of the coastal states for sure, for flood and hurricane risk. But then you have hail risk in states like, Texas, et cetera. So it's one thing or the other. And again, as homeowners, we all have to start getting educated about what the key risks are, so we can at least take our own local steps to correct, sort of mitigate the impact of those things. And there's a number of things that homeowners can do to mitigate those impacts. So I think it's upon each one of us to do that. But at the same time, I think carriers are definitely going to increase premiums to correct their profitability based on these risks. And we are seeing a temporary sort of exodus in some ways in states like California, but they'll come back. I mean, people have to get insured, lenders still require it, carriers still have to be in business. They've been around for 100, 200, sometimes even longer. So things will come back. It will be just more expensive to buy.
Yeah. Okay.
Would it be okay to chime on something from before?
Of course, jump on in.
Awesome. I'm always, processing on like the butterfly effect, right? Like how one little thing can lead to multiple, right? And what's really fascinating, because you asked the question before, you said, should people out there expect measures like this in other municipalities? And there is something really interesting happening. I mean, obviously, we all know in society right now, we're divided on everything, right? It's just like here, there, like across the board. Well, one thing that is also new is, for a very long time outside of places like Santa Monica or New York, right? Even in places that were more populated by renters, you did not see measures often passing that were antithetical to the desire of homeowners, right? In fact, measures even in California, right, famous for Prop 13, passing in the late 70s, but continually, even as the state got quote unquote more liberal or whatever, you still see Prop 13 was always sacrosanct, right? Well, the population has changed, right? So California for the first time is now majority renter, right? Like that was not the case for a long time. And even in areas where that used to be the case, there was always this idea of, well, even if I'm a renter now, I can be a homeowner later, right? Well, as people's perceptions of the ability to become a homeowner alter, right? I mean, it's the American dream, right? I'm going to be a homeowner, right? Well, if you have more people who think, well, it's not going to happen because it's either A, unaffordable, or B, I couldn't even get a home if I want to get a home, then you can absolutely expect, as a natural ramification of that, more political measures that are either, hey, there's only these few people are the homeowners. Yeah, we're going to, tax them more, right? Potentially. Or we're going to, want more measures, protecting renters, right? Like these are the outgrowths of, again, going back to the inventory, right? These are natural ramifications that occur. And it's why it's such a big deal to be in a situation where, I mean, I keep thinking about Billy and how many people, show up here. Like there are more buyers than sellers. It's really important for everyone to remember that, right? On a supply demand basis right now, prices are going up at the most base understanding. Prices are accelerating because there are more buyers than sellers. The natural outgrowth of that should be more sellers hit the market to meet the demand of how many people want to buy. But we are not seeing that. We are seeing the alternative, right? Either they stay put or retract their inventory. Therefore, there's more pressure, for the homes that are there. And that there's ramifications of that, right? Also, one thing I think someone, I forget which panelist, but I think it might have been Avi, we were talking about second homes potentially. But another kind of stealth thing that we all overlooked is that in 20 and 21, the rates on second homes were very much on par with primary residence, right? Like you were able to buy a second home and get a rate almost the same as a primary residence. You had lots of people, going for remote work and grabbing rates into 2s and 3s for second homes, right? Well, today the rates on second homes are identical to investment property. That is a big deal that shift happened. That's with everything that we've talked about, that always gets overlooked. But again, it's something to really consider again with what is happening with the inventory, happening out there, because that means someone who had one side, they can't let go of that for a different. They are now locked into that second home that they have. They cannot transfer it, because it's not just about, the rates would double. Yeah, in that case, the rates would triple, right? So more pressure on the inventory, as far as, people who, bought their home to, Zoom away and, remote work. I mean, the San Francisco Fed did a study. They tracked a good chunk of that price acceleration to remote work, right? So these are just things to keep in mind, right? There's always the butterfly effect. It's not to negate everything, Billy noted, like, eventually things just normalize, right? But in the process of what the new normal will be, we have a lot of factors out there, in the ripples in the pond.
Let me ask you this really quick. You mentioned sort of the political ramifications of sort of the landscape that we're in right now. And you said something really interesting. I thought that there's this perception among some renters that they can't make that step up to home buying, that they can't do that. And I guess I'm wondering if you could weigh in on sort of the accuracy of that perception, right? Like, I know a lot of people do feel that way. And I guess I'm curious, is it legitimately harder for people to sort of climb the real estate ladder today? And if it is, how much harder versus, a generation ago? Or is that mostly just a perception? Can you speak at all to that?
I'm going to try to answer this as like neutral and objectively as possible, and all my ADHD impulse, and just, really I'm going to breathe and make sure I can answer this as delicately as possible. Okay. What's different is not the ability to purchase. All right. And I want to make sure I try to like clarify this as much as possible. It's where you can purchase. This is what's difficult, is that in many ways, the ability of folks to buy where they want to buy geographically has clearly altered. Right? I mean, that's just reality, right? I mean, the places that Billy talks about, right, in LA, we're just using LA. Sorry, if you're not in LA, I apologize. Like, I mean, we can talk about other places. It's just, it's happening. I'm sorry. All right. But if there used to be, okay, you could buy in the Valley, or you could buy here, and there were all these, homes that were just being built up, right? Yeah, but now those homes are built. So now you can't buy the new home. It is now a used home. It's an existing home, and people don't want to leave that home. So there's just more and more pressure. This is just supply and demand. Here's the thing. There are 30 million people in the United States of America who have assets over $1 million. Now, you may or may not be one of those 30 million on this call. You may have ideas about what you think about the fact that there are 30 million people who have over $1 million and how many don't. That's a different conversation. The simple reality is, if there are 30 million people who have assets over $1 million, and there are only 600,000 homes available for sale, then there's a lot of people who have a lot of money to be able to buy those properties. And if you are starting out and you had ideas of, well, I want to own this type of property in this neighborhood with these schools and this ability, but there's only 5 of those available, right? I mean, I have friends that just went through this. I mean, literally just went. 2 of my best friends wanted to buy a place in Glendale, right? Really, and how many, there were like 5 places available. I didn't pick that out of like thin air, right? And each time they wanted to write an offer, there were 20 plus offers on the houses that were there, because that was just the reality, right? Now, I promise you that 30 years ago, that wasn't the reality, right? 40 years ago, that wasn't, the same reality. It was the reality for those few years where the inventory was shrunk, right? But if you look, I'm a born and raised New Yorker, right? And I love Manhattan. Like, I'm sorry if you live in Queens. The Mets are my favorite team, but I prefer Manhattan, okay? But if the prices are what the prices are in Manhattan and I want to own, I'm then faced with this conundrum. Well, I can bang my head against the wall about what the prices in Manhattan are, or I can go see what the prices are in Queens. Now, that is what I'm trying to say here. Like, there are homes in the United States that are available. You can purchase property. It's about where you purchase. Now, where my kid goes to school, his elementary school, I have seen 6 people move from his class in the last year to Texas, right? To Oregon, to different places where homes are cheaper. So the question isn't, can people buy? Most people can buy somewhere within a certain income strata. All right. I'm not saying everyone can. No, it'd be ridiculous.
Yeah.
People would throw eggs at me. That is not what I'm saying. I am simply saying that it is true that there are lots of places in the United States where but then we get into other sociological factors. Sorry, I have a sociology degree. People might want to buy where they are close to family. You might have children and you want to be near grandparents because you might want to be able to go on a date. All these things come into play, right? And what is getting harder is for people in the beginning stages of their, careers and life to be able to purchase near where their, parents are, if that is in a neighborhood that is accelerated on income. So that is what you are dealing with, is this, I mean, there's different levels of pain, but it is a pain of the upper middle class and, just middle section, depending on where you are, income strata, that you don't have the ability to pull off a purchase where you think you should be able to pull off a purchase. That is true.
Let me.
I hope that was fair enough. I was really trying there. Okay.
No, yeah, I love it. I mean, I don't love what's happening, but I love the explanation you're offering here. And we're talking about sort of people climbing that first rung on the real estate ladder, like the first time buyers and that kind of thing. But I actually wanted to ask Billy, you had mentioned you're working with like high-end clients, folks who are maybe a few rungs, either they started a few rungs higher or they've climbed up a few rungs higher over the course of their lifetime. I guess I'm curious if you're seeing anything sort of related playing out in sort of the luxury space. Like, are people having to make choices about where they live or the size of their home? Like, or are you seeing kind of similar trade-offs? Talk to me about that.
Well, I think that, I definitely have clients who would, they would like to get another house. They'd like to, go up a rung or 2 or 3.
Right.
But when, if they're getting a loan, they look at it as, well, it's not quite the next rung up or 2 that I was hoping. It's kind of a little bit more lateral. If they're all cash, it becomes a different story, because I, and Mike's heard me say this before, but I find that the wealthiest are the ones who most predict the doom and gloom the first. And I've had clients, I can think of a few off the top of my head, who would be buying, 20 million plus, 40 million plus type homes. And they're the ones who are saying it's overpriced. Prices are going to be falling dramatically. And they've been saying this for like 7 years. And, because everything has just continued to go up, and it becomes, so they're like, look, prices are going to go down. I'm going to keep my powder dry. I'm going to be there and ready to pounce as soon as prices go down. And they're kind of like, the broken clock that is, twice a day correct. Eventually, presumably, they will be correct. And kind of going back to what I was saying earlier, if you compare the 2018, 2019 market to today's market, and you see the metrics pretty much lining up as they were then, same now. The one metric which really most is different is price. While we saw, the 18-19 market here and then go up, with that post-COVID spike, and then has settled down with, lack of inventory and number of sales and interest rates rising and all that, prices have steadily risen. There's been no declines in prices whatsoever. So, the question becomes, is this the new normal? Are we going to continue to see an equilibrium in supply and demand? Is demand going to outstrip supply? Are we going to see, impacts from the strikes? From the commercial sector is in crisis zone, because you've got landlords who they've got all this commercial office space in particular that nobody wants anymore. You've got tenants which are being have been protected with what they've been paying, and will either get relief or leave. and then you've got, the tax as well. And so, we may see people losing wealth that are owners in that sector and therefore having to sell off property. I look at developers who bought properties 2, 3, 4 years ago and pro forma'd what their exit price was going to be like based on an accelerating market on construction costs that were completely different from when they entered into the market. And the big question to me is, are they going to have the deep pockets? Are they going to be able to outlast the market and sit around and hold those properties on the market without having to have these pretty stratospheric decreases? We're seeing more auctions of these properties coming on. And look, I mean, they look like there are these extraordinary bargains. I think in large part it's really they were priced so optimistically that we've kind of settled down where they ultimately sell to kind of where they should have sold in the first place. So I don't know, but I think that's where we could see some real change.
Jim,
Yeah.
would it be okay to put a ray of sunlight here? Because I
Yeah.
is that okay? I want to throw in a couple of thoughts.
Well, yeah, I think maybe, we've got less than 10 minutes left here, and I did kind of want to end on a positive note. I know when we were preparing for this meeting here, I took all of what the three of you were saying, and I said, this sounds grim, and all three of you guys are like, no, that's not the case. So maybe let's start pivoting here. We'll kind of just go down the line. Mike, we can start with you, but talk to me about why maybe this isn't as grim as it sounds, like why the inventory, the climate change, all this stuff. Like, give me your rays of sunshine.
First of all, I think the last year has proven that real estate is one of the most phenomenal investments that anyone could engage in, period, right? If you go back a year, to when the rates first started accelerating, there were probably 1,000 articles that were just convinced we're about to see a real estate crash worse than 08, right? I mean, it was just, we're going to be in a recession. It might even be a depression. Real estate's going to crash. Everything is going to collapse. This did not happen, right? And I think it's really, good to know we don't have a recession, right? And now most people are saying, yeah, we're not going to see one, right? In fact, one of the reasons that is the case is because how many homeowners have those low rates, they were able to keep spending at the same level, even though the Fed was raising rates, which kind of forestalled, that recessionary pressure. Also, we're very lucky to be in the United States. If you go to the UK, right, and rates rise in the UK, your mortgage rises with it. And like the 30-year fixed mortgage where rates don't accelerate as rates go up, that is a, really big deal. We are very fortunate, and home buyers and homeowners should be very happy that their rates don't go up with, the rates going up unless they got like a 2-year ARM or whatever. But from that 30-year fixed is not something that exists in a lot of places, right? So when we look at the landscape right now, unemployment at 3.7, right? You have rates are still incredibly low by all historical measures. Inflationary reports, coming down the pipeline that are continually positive. A lot of folks thought we were in 1970s level land, right? It is much more plausible and much more practical now that we can see that the inflation we went through was much more in line with 1946, 1947 inflation after World War II. Given the fact that we spent in 2 years more money than we spent in all the years of World War II, that makes a lot of sense, right? 5.5 trillion fiscal spending, not even counting monetary spending, just in the 2 years of COVID versus what we saw, in 5 years of World War II at 5 trillion. There were pressures, right? And now it's easing, and there's rays of sunshine all over the place for what we're dealing with. I think Billy is absolutely correct. I think we're going to settle into like a 2018, 2019 style level on all fronts. It's just the volume component of that I want to keep, pointing out, that we have to wait for that to return. And that's the main thing I'm, just focusing on. All right. But positive, man.
Let me cut you off there because I want to give everyone a chance to sort of offer their own rays of sunshine. Mike, you've got some fans here, multiple fans in the chat. So you'll have to communicate with folks after. Billy, let's go to you. We've only got a couple of minutes left. Give me sort of your ray of sunshine. Then we'll get to you, Avi.
I mean, we've seen, and it's been proven out, that owning real estate is the best hedge against inflation. It's the best investment you can make. There's no other investments where you put down a small amount of money and you get the full amount of appreciation. We've done numerous studies where we've looked at, LA County as a whole. And if you've owned your home for 7 or more years, you've always made money, no matter what day you could have bought it on the day before the Lehman crash, where you had this incredible 30% erosion in your value, and yet you still sold, 7 years later, it was worth more than it is today when you bought it. So, I think there's a lot of reasons that people want to own homes. There's a psychic value. It's an extension of your persona. You can do things to it you wouldn't want to if you were a tenant. So people will continue to want to buy. There are great tax benefits that come from it. I don't see people moving away from owning homes. And again, as we get to consistency and stability, we're going to see more sales. But I think that, if you see something today that you want and it doesn't come up very often, lock in on it now, readjust your mortgage later. Insurance will get better down the way. And I do see this as a time where, as we might mention, we kind of avoided recessionary times, and I think we're going to move into this new normal of stability.
Awesome. Avi, let's go to you quick. Wrap us up here. Share
Sure.
something optimistic with us.
Yeah, no, I mean, insurance is as basic as bread and butter, right? I mean, this is a must-have. I'm talking homeowner insurance, of course, and it's here to stay. It's been around for centuries. It's going to be around for the next many centuries. I think the industry at large will collectively find a way to get back into normalcy. It won't be the same normal we've all been spoiled with, but it'll be a new normal for the interest of consumers. And then, of course, it's a free economy, right? I mean, it is a competitive market. There are over 100 insurance companies operating in California alone. And it's just the whole economic climate will make sure that consumers' interests are protected. Of course, we can't expect to go back to where we were over the last many years, but we'll have higher premiums. But I think we shouldn't be afraid that we won't be able to insure a home. And I'm talking, there are always outliers, but in general, I think we should not be afraid that we won't be able to insure homes at all. It's just going to be at a slightly higher price point to take care of what's happening. And again, as I said, as homeowners, it's our collective responsibility to make sure that we are mitigating risks on our own properties, right? We got to take corrective measures, and the more of us do that, I think the better everybody else will be.
Awesome. Well, thank you all three of you so much. We could keep this conversation going for hours and hours, and it would be fascinating. But I feel like I've learned so much from the three of you. So thank you so much for chatting, and thanks for all the comments in the chat. Sorry we didn't get to all the questions here that the people were raising, but yeah, thanks so much.